We'll repeat and start this August 13, 2021. Thanks for watching. So just from top of my head, gap up to all-time highs and raise guidance means an average up entry is needed for Disney, SolarEdge, Palantir, Qualcomm, Ford, Upstart, Datadog, Atlassian, Ari. Actually, Ari and 968 are not all-time highs. They are in the reversal mode. Sorry, this is a wrongly inputted slide. Gap ups, sell downs, great numbers for reversal move. You add on to Desktop Metal, Origin Materials, Hims and Hers, Clove, Square, Shopify, PayPal, Roku. Now you might wonder why Square, Shopify, PayPal, Roku in the sell down reversal move. The truth is they're actually hitting all-time highs, but they were actually sold down by the market, which actually gives you a contrarian buy on all four of them. Gap downs, great numbers for a contrarian entry, SoFi and Sunrun. We saw the numbers. Some people actually are selling SoFi. We think that is actually a misinformed judgment. Gap downs and bad numbers, short on rallies or avoid. App Harvest, Fastly. Unfortunately, even Copin and Vusi had delays, so it's actually an avoid. Gap downs and good numbers so far. We're actually wondering why the market sold down. At least me personally, I'm wondering why Growth Generation got sold down 20%. I didn't see anything wrong from the earnings. So of course, even if I see nothing wrong in the earnings, it's possible that there could be something wrong that precipitated the 20% gap down. So usually when I see that the market doesn't like something, I would not necessarily be contrarian until I actually know after a few days. So this one is still a question mark on my end. So this is also important for everyone. You need to learn to buy bottoms. This is a very important trait. It's because out of despair, you actually get astonishing 10x moves. A few examples for everyone to understand. Past examples, Overstock, Scientific Games, Capri, Fetch, Jumia, Snapchat, GME, AMC, Hertz, Neo. These are just some companies that actually look to actually just be winners today, but actually were actually previously 90% losers. Most of the people actually hated these companies in the past. All right, there are questions as well. Let me just finish answering that. Okay, there's a question. QuantumScape exercised the warrants early. Do you know why? Actually, there's no reason for a company to exercise the warrants early, but if they wanted to, it is their prerogative. It's possible that they want people to actually get the shares and actually exercise it at 11.5 for whatsoever reason. They'll discuss it. It has no bearing. It's not a bullish or a bearish thing. There's no reason. For QuantumScape, we read the numbers. We like the milestones. So we're actually bullish. And if you have the warrants, we would suggest you exercise and buy the shares outright at 11.5. Okay. So just for instance, if you are actually seeing drops, is that normal? The answer is yes. Wall Street, in our view, always has a tendency to go down massively when it wants to fall down, as trends usually are always losers lose, winners win. And for a moment in time when Overstock actually had a drop during the crypto drop before, you remember when Bitcoin was actually 20,000 falling to about $3,000, Overstock actually fell from $80 here to as low as $3 here. It only bottomed around March 2020, also when Bitcoin bottomed at $3,000. So it could have gotten to $2 and $1 as well. So usually when Bitcoin was falling down, it was actually a reason why Overstock was falling down. And when Bitcoin stopped falling down, it also made Overstock, actually before the MicroStrategy of the market was Overstock. It was not MSTR until Michael Saylor came. It was Patrick Byrne first, not Michael Saylor. Either way, you could see that the Overstock still has a lot of crypto-related names. And if you understood why it was going down and why it was going up, you had that chance and saw that that 90+% drop was an opportunity of a lifetime. Hence, that $3 rally to as high as $140. Okay, so even now, you could see that that overshoot move is just in a consolidation that is actually in an uptrend. 140 dropping to $40, rallied back to $100, now at the $70, 50% down from there, but actually $70 from $3 is a 20x move. This is why we are saying that when you are trying to bottom fish, let's assume you bought at 10, it went at 3. You might have thought that you were a loser, but the truth is, it is possible for stocks to go 90% down. And if you're buying it at 80% down from an all-time high, you could still be early. So you're right that it was undervalued, but you can never know the actual bottom, and you should actually not give up. If you're buying at 10, you should have gotten more at 3 or 4, or you should have at least bought more when you were seeing it reverse already. It's easy for some people to say, wait for the reversal before you buy, but there was actually reversal here at 10, rally to 20. So it's actually not easy to say that 10 to 20 and 10 would go back to 3. Easier for people to say things when they're actually not in the middle of it. So me personally, I'm going to talk about experiences because Overstock, I did buy this at the lows. I didn't imagine actually for it to go as high as there. I was buying about $7. Indeed, it went to 130. I thought that about $20. I sold early, thinking that it was already good enough. You'll notice why was 20 my target. It was because before there was this $20 area before at that level. So past is past. I'm going to give you experiences to help you illuminate how to handle big drops and big reversals. Scientific Games, let me tell you this. This is a company went from $30 to $3 and now trading at $70. Now this gap up happened because Scientific Games actually got bought out and acquired at $27. It was something that we were bullish upon. We're actually willing to buy at $4 and $12 here because we saw that casinos were not going to go down to the drain. So it's very important that when you are buying, people are thinking, and I'm gonna reiterate an Ian Cassell quote here. Ian Cassell said, buy and hold is not buy and forget. Buy and hold is buy and verify. Let's assume that you were buying Scientific Games even at 10 and you were actually wrong. You thought that 30 went to 10, looks like good at bottom. Let's assume you made a wrong call. 10 went to 3. The important thing for you to do was, since your bearish thesis was not really that wrong, you should have held. And holding on would give you that even if you bought at 10, it's now 7x from your price point. Don't listen to people who say you should have cut la la la. From our experience, if you're buying, you have to just diversify this and make sure that your thesis is intact. I'm assuming that you probably would have sold it because you saw casinos were often going down. And it's not easy to see that your casino, which is Scientific Games, was catering to casinos. It was a company that allows casinos to do online software for lotteries. So they are selling software for lotteries, for casinos to do digital. So it is similar to IGT. The business is very the same, SaaS companies. But when you have a downturn in cyclical companies like casinos, their revenues will suck up during that quarter. You have to understand, when you're buying a cyclical company, cycles come and go. It's very important to all awesome 10x investors that when they buy, of course, a 50% drop is not unnatural. It is something that you have to keep in mind. It is possible, hence asset allocation, diversification. Capri Holdings, the same thing. I saw that this was a good buy, somewhere at about $20. At that point in time, it was somewhere here, $26. It was already being insider bought by the company. Versace was buying, Michael Kors was buying, and it was that point in time. Why were they buying? If you're wondering, 2019 to 2020. From about $70, they felt that a 50% drop at about $26 was good enough. Indeed, they were right. 26, it actually quickly rebounded to $40. Then again, however, if you didn't sell, and of course, during that time around January 2020, end of the February, you already know that COVID-19 was happening. It was very apparent that all retail stores were going to go down the drain. So down the drain, 40 went as low as 5. 90% down. You could argue that you could have sold at 30 or 20, but let's assume you didn't sell at 30 and you didn't sell at about $25. Sometimes if you didn't sell during that time, the right thing to do was to hold on and to wait for a bottom. Why am I saying these things? Experience. Only a person who has experience will tell you that Capri Holdings was not necessarily bleeding on fire their cash or retail. Obviously, during COVID-19, when you see 30, 50% drops, and when you know that the business is not going to collapse to zero, you don't have to naturally sell. The tendency of people is to actually just sell ahead. And obviously, they'd say, oh, it's a good thing I sold at 30 because now it's at 5. Sure, everything is in hindsight. What is important, of course, is to also know that you know how to buy back. You could be good in selling, but if you don't know how to buy back, it's also irresponsible of you. So we did give a buy call on Capri Holdings. Yes, at about $5, $10 when we saw the bottom, of course, it was obvious to buy. It's very hard to know that it will recover just as it did today, 5 to 60, 12x. But what do you learn about companies that actually have a sudden problem that is not really something that people can foresee? You cannot say that Capri Holdings knew that COVID was going to happen. When COVID happened, everything dropped. Some stocks dropped 90%. Capri Holdings dropped 90% in a single month. If you will calculate that, 30 to 3 or 5 happened in a single month, February to March. So that was a time that I was thinking casinos, retailers, even airlines, of course, they dropped. Those were actually opportunities of a lifetime. You can answer things only after hindsight, but during that point in time, you also have to recognize that the proper thing to do, if you actually unfortunately have anything in the victim zone. Why am I saying this? Because many people are actually victims right now of Chinese stocks. And it's not actually wrong of you to actually suffer a 20 to 30% drawdown and holding on to that drawdown. I would not tell you to sell because you could have been the same case here from Capri Holdings, which will actually rise 100% to 500%. And you may say it will never happen, but we are giving you examples that, of course, it can. Farfetch, the same thing. This was a 50% drop, 20 all the way to 10. 10 goes about 6. And now in hindsight, you know what happened to Farfetch, 6 to 70. The tendency of Wall Street always is if there's a bad earnings, or in this case for Farfetch, this was an acquisition that they didn't agree upon. Afterwards, right now, they're selling Off-White. Farfetch bought Off-White here. During that acquisition, Farfetch was penalized 50%. This happened, 20 to 10. And then, because their earnings was not going to actually glimmer with that acquisition, because acquisition means they have to spend money and finance that acquisition, the market still penalized them for a year. Plus the COVID, that's why it was still at 6. But when the markets already saw the reversal on earnings, you could see that when earnings come out, all of the obstacles were very low ball. So it was easy for a $6 to hit $50. Actually, I thought, I was trying to tell people to buy Farfetch at about $7.50. We gave a buy call on $7.50, but personally, I thought that $20 was enough. Just back to the pre-acquisition of Off-White. Over time, this was something that I didn't expect. 20 could hit 70. And nowadays, Farfetch, Virgil Abloh, Off-White got sold to Louis Vuitton. So Louis Vuitton bought it at a premium, and notice Farfetch, of course, benefited from there. Whatever way you think about it, these examples are for you to learn about what happened and what will happen. Always in drops, people just like to think bear case. They don't actually think about the bull case. Jumia Technology is the same thing. I remember when we were giving a buy somewhere about $5, it rallied, it dropped. 5 went to about nearing 10, and then it dropped all the way to 2. So initially we were bullish, and then when it was going to 2 to 5, I was still thinking, was my bullish case about Jumia wrong? The case was Jumia was the Amazon of South Africa. And they actually had deliveries, they had e-commerce, plus during that time, COVID. So it's impossible to think that in an e-commerce world that a COVID-related beneficiary will actually be negatively happening, right? Nonetheless, why was it sold down from about $50 all the way to $2? Yes, 50 to 2. Obviously, I didn't care about the company 50 to 25. I knew it was expensive. But about $6 to $10, I was thinking, how bad is bad? I know Wall Street hates Jumia because about the execution. But at some point in time, I do study companies that are downtrodden 80%, 90%, and I try to think contrarian. What is it that the market could be saying wrong? Is this a fraud? Does it deserve to go to zero? And when I think it doesn't deserve to go zero, I give a bullish call. So I gave a bullish call in Jumia at about 7 below, and people was actually wondering whether it will even rise. Eventually it did. They did take profit again at 20. And then, of course, these are things that we cannot explain already. Sometimes when the market likes a company, they just push it up all the way. Just wanted to show to you what happens when the market likes it. When COVID deliveries and e-commerce actually went up, momentum also happened, short squeeze happened. This what happened, 2 to 70. So 50 to 2, 2 to 70. You may actually think that 50 didn't deserve to go to 2 and 2 didn't deserve to go to 70. but you could see ranges explode when people are wrongly misinformed on the downside and on the upside. Maybe right now where it's 20, it's more on the mean. Snapchat. For a time, Snapchat was hated by Wall Street. You still remember the time when the Kardashians actually said, who's in Snapchat? Nobody. So that was a point in time when Snapchat had its worst times around $5 here, 2019. So you would think that a company going from 28 to 5 is one of the companies that everyone should hate. I still remember when you look at Wall Street, all of them would say, even the best professors and the best analysts would say, nobody loves Snapchat. And the fundamentals were bad. So even Spiegel had to prove over time that it did. You could see that $5 eventually went to 20. There was a retest during COVID at 10. If the business fundamentals were doing well, this is what happened. 10 went to 75. What's the purpose of showing these things? The purpose of showing these things is that just because you see a chart down 90% or 80% or 30%, 50%, 70% does not actually change the fact that you have to look at the business first. NIO, the same thing. 13 to 1, 1 to 60. I kid you not. This is a company that went to $1 around 2019 for fears of bankruptcy. It was helped on by the government, especially Tencent. Tencent bought. Why was it falling? Burning cash. So a company just like Tesla was burning cash. And just the same, people are actually wondering whether they could actually survive or go bankrupt. When their solvency issues were actually fixed easily from 1 to 2 to 3 to 4. And then eventually 4 goes to 15, and people are actually wondering whether 15 can even rise. This was a time that, to be honest, I was still skeptical whether 15 would rise. And the market actually already headed up because deliveries were really going 100, 200, 300% growth. And until now, NIO is still trading at $40 because their consumer deliveries are always beating the mark. Recent earnings of NIO beat estimates yet again. Notice the ranges, 13 to 1 to $60. If you ever thought that the market knows everything, that the price knows everything, the answer is wrong. The kinds of ranges that a company can have in a single year and in a single 3-year dimension is as wide as 10x. For growth companies, usually startups, not everyone understands. It's very hard for people to predict. That's why volatile ranges are the norm. It's not a black swan. That's the norm for startups. Hertz Global. I remember at about $1, we were saying, if you look at the replacement value of all the used cars, it was actually bigger than 1. And yet, from about $1, indeed it rose to $2, nearing 180, and then it fell all the way to about 40 cents. A while ago, of course, that was around 2020. Then 2021, you saw used cars actually getting rented out. You saw even the spike in used car sales actually selling well from 40 cents to $9 to $10. The purpose of showing these charts is not to actually show to you, oh, this is what happens when you buy a 90% down. But you have to understand that what people hate the most is something that they could either be very wrong about or they could actually present a huge opportunity. So, well, actually, it's not an or. Usually, there are, of course, 90 other examples wherein they're right for being bearish, but also these are kind of examples wherein you have to put your fundamental take, and the fundamental take will actually give you that the 90% drop often, when it's wrongly misjudged, can give you a 10x, 20x move, not within a year's time, sometimes less than 6 months. This 40 cents to $10 move, which is 25x, happened from March till July. 3, 4, 5, 6, 7, 5 months. Of course, everyone knows about what happened to GameStop. GameStop is a company that suffered a 93% drop first, $60 to $3. The main thesis of the bears was the bearish apocalypse, because everything in the digital meant that all the games were not being bought from GameStop. Bear thesis was correct. However, after some point in time, e-commerce sales were actually growing and Sony PlayStation was happening. That's why Ryan Cohen bought a big stake on GameStop after a 93% drop. Take note, whenever a stock goes down 80 to 90%, usually activist investors come in. And that's what happened to GameStop. Ryan Cohen bought, Michael Burry bought 20% of the float. in that zone here at about $3 to $4, even if you were selling it, you should have been covering at $5 and $7 because you know that it is gonna be returning to a rebound at least to $20. You may not have thought that, or you could not predict that $3 can go 450, a 150x move in less than a year. It's very hard to predict that. But 5 to 20 was an easy fundamental judgment. Sometimes when you are correct in buying the bottom, you always have that jackpot move. It could go 10x, 20x. In this case, it was a 150x move. Who would have known a 150x move? So why am I talking about that? These days, indeed, unless DouYu is a fraud, this 83% drop could be 90% drop. Sure, $20 DouYu could go down to $2. We saw companies go 90% down. But it also meant that the 90% down could lead to a 10x, 20x move when the reverse is true. Currently, it's very clear that DouYu suffered an 82% drop in the last, when was this? Around 3 to 6 months, around that time, because of a blocked Huya DouYu merger and because of regulatory frameworks for spiritual opium. So there is, of course, this Chinese regulatory, and the biggest suffering collateral damage so far that I can see in the entire Chinese stock listed in US is DouYu. And because I think that there is live streaming efforts that will continue in the next 5 to 10 years, if DouYu is not going to go 0, it means that 3 can go to 2, but eventually go back to 10 or 12 or 20. So if you're actually holding any DouYu shares, you don't need to buy, but it's also wrong for you to sell. You could be the same factor in the same thing, just what happened with Capri. When Capri suffered from about $30 all the way to $5 and eventually went to 70. When you see a bottom, wherever that bottom is, of course, you'll buy DouYu. Whenever that bottom is, it will be a screaming buy. When it's gonna happen, wait for the updates. Usually, in my view, the reversals happen after a catalyst. So that catalyst could be business momentum. It could be a business update. The next update of DouYu is August 16. And then, of course, watch for Huya's decisions as well. And then read Tencent's reports on whether, even if they don't have a plan to merge DouYu and Huya, because Tencent owns DouYu, you will ask, as a normal investor, Tencent who owns DouYu and Huya, the normal question is, will they buy more of DouYu? Another question that I want you to actually evaluate, one company that I didn't put here is actually Dada. Dada's results are actually good. And I've seen that the recent industry reports fundamentally is that all the e-commerce deliveries have been growing 100%. E-commerce deliveries will never happen if nobody is delivering them. Hence, Meituan and Dada have a real business case here. Same as for SF Express, YTO Express, ZTO Express. When you see delivery couriers getting penalty of about 80-90% by the market, even when the entire fundamentals of the company is not actually changed, plus the insider buying of Walmart and JD.com buying more and more, privatizing Dada, two things can happen. Either Dada can buy in as a private company, it can be privatized. DouYu as well can be privatized. That is something that could happen. It could be bought out. It's possible that a merger might not happen, but it could actually get a buyer, not in the sense that it gets privatized, but Tencent can just buy more stake. Because Tencent already owns DouYu and Huya. Don't actually misjudge that they can buy a company if the growth is there. Okay, AHT suffered something like 80% down in the last 3 months, and yet you could see that the numbers of occupancy is actually close to 70%. So you are not seeing a big Delta variant impact. These data points are important because these are going to signify whether the bear thesis is correct, that all the hoteliers are actually supposed to go down and become victims or not. So far, the numbers are showing to us that most reopening companies are actually blasting upwards, with SeaWorld going up, Six Flags going up, Disney going up, Expedia going up. Airbnb didn't beat, but it's not a bad drop. So telling you reopening stocks in general, from Wynn Resorts casinos doing well, tells me that the bearish case on hotel industry and travel tourism, I believe that the bears only have the charts to give them the bear thesis. The fundamentals are not in agreement with them. So Ashford Hospitality, if you notice here, the bottoms here, about September, November is about 13, 14. Why was there a 1 day 100 to 200, 300% run up here? Remember, look at this chart. This is a 300% move, by the way. So if you think that 14 can never hit $50, well, look again. The chart here tells you that this company, I don't know why it actually went 300% up here, but volume is there. I can tell you what happened here. November was the start of Moderna and Pfizer vaccines. And if my theory is correct, that this is a massive short squeeze about to happen, look at the volumes here. The institutional holdings of Ashford is above $20. So if you're buying 13, 14, and you're looking at the upside here, it is very immature for you to think that $20 is the minimum. Because yes, first target 20, next target 30, and then 50 is still a target. Why am I showing these things? Because experience. If you study all the companies that fall 80 to 90%, these are not charts that are normal. These are extraordinary events, a drop from 40 to 14 without any revenue miss, without any earnings miss, but a simple reverse split is not actually reminiscent of a business deteriorating. That is giving you the case for a contrarian buy on Doyu and Ashford. So if you have it, you don't have cash, doesn't matter, but hold on to your position. Now, if you're thinking about short candidates, Moderna and BioNTech are actually the short candidates here. Yes, Delta variant is raging, but then again, Moderna, all the positives have been priced in. After a 27x move and a 20% drop from 480 to 400, my guess is as good as yours that 480 is the short-term peak here. And usually, after a big move like that, all the companies that I've seen, you saw it already, I showed it to you. Overstock went from 3 to 140, fell down to 48. So let's assume it goes down 50%. 480 goes down to 240. That is normal. 400 going to 240 is around 40% drop. So the drop is huge on Moderna. BioNTech, almost the same thing. This is the partner of Pfizer. So Pfizer is distributing the drug made by BioNTech. This went from about $12 here. Even during the March 2020, you just look at the COVID vaccine here, around $40 to 440, 480. So 480 to 380 in my view is the first sign of a top. Any rallies to 440 will be sold. Where is the support? 50% downside at the very least. So at least 220. Careful about BioNTech and Moderna. These are going to be shorted. Okay, let's talk about biggest reversals from earnings catalyst for 2021. The recent 2Q 2021. You have the biggest upside surprises in my view on Open Door, Hims & Hers, Origin Materials, and Clover Health. The things about these four companies, let's discuss. Open Door and Clover Health are chamat SPACs. Huge hype, Reddit favorites, highly shorted. Those are recipes for a short squeeze because all the chamat SPACs have often been equated to super hype but no numbers. Unfortunately, to the shorters of Open Door and Clover Health, the numbers are actually with them. Let's show to you each one of them. For Hims and Origin, also the same. High short squeeze candidates. These four, in my view, are going to be short squeeze candidates where the bears are wrong for being bearish. And then if you want to go for the easy names, you cannot argue that Unity, Palantir, and Disney will have more buyers and could continue to all-time highs. Very good numbers, and yet these are crowd favorites. So it depends what you want to do. Do you like to just buy crowd favorites, or do you want to actually buy and squeeze the shorts when they're wrong? So obviously me, I try to actually be on the squeeze short move because I actually love capitulation and to actually kill the shorts. Let's take a look at the reward opportunities for Open Door. The reward opportunity first is 20 to 22, but that's just the first resistance. When they continue to make a 3-month breakout and another 6-month move because of earnings continuing momentum, you'll see this go from 14 lows all the way to 38 to $40. It could potentially go all-time highs. And so you could see the basic chart movement of open door, real estate. This is a box breakout at $18. You have a buy point here at 18. Any drops at 16 is still a buy. If you really want to be adamant on a cut loss, your cut loss is 14. So obviously, some people will say that is such a wide stop. Because 18 can go 16 or 15, doesn't matter. End of the day, the move is 22 and the move is potentially even as high as $30. So strong buys 18 to 16, open door gets a buy reco. And if you think about it, why did open door go up? You've already been seeing all the news. Real estate market is red hot. In fact, the inflation, people actually are selling millions of dollars. So let's take a look at the numbers. Each quarter, we get the opportunity to reflect on our journey to redefine how people buy and sell a home, transform the world's largest asset class. The largest asset class is still real estate, not stocks, not Forex, not crypto. Last quarter, I spoke to our tremendous momentum created by the relentless focus on the consumer experience, pricing expertise, and operational excellence. I'm proud to share the results of these efforts. In the second quarter, we acquired 8,494 homes, revenue of $1.2 billion, adjusted EBITDA of $25.6 million, growth of 136% in homes acquired, 59% in revenue, nearly $28 million in adjusted EBITDA compared to the first quarter. Another evidence of a seismic shift, consumer demand towards the modern real estate experience which we are pioneering. Is Opendoor the only company here? Nope. There is, of course, another company, Zillow and Redfin, which actually tells you that if Opendoor is doing something like this, should you actually take a look at Zillow and Redfin? Okay, let's take a look at that. Zillow so far has not reported numbers, but, oh, it also did. Surprise of 80%. Sorry, it has already reported numbers. So this will actually give you a contrarian buy as well. So Zillow, Opendoor, let's take a look at Redfin as well. 3 companies in the real estate. Also positive movement here. So the biggest surprise is actually Opendoor. So who will actually buy this up? Well, everyone who wants to squeeze the shorts. Okay, let's take a look at this. A 24% up move last night is enough to make all the shorts be afraid. And actually, all the momentum in the sideline are also going to buy Opendoor. Company overview. So you just know that this is a company that's a leading digital platform for residential real estate. They are able to help you buy and sell your home. There's just 3 companies here, Zillow, Opendoor, and Redfin. All of them positive moves, whether you're getting married, starting a family. Opendoor is operating a number of world cities, neighborhoods across the country, la la la. Okay, let's take a look again about another short squeeze candidate, Clover Health. Clover Health, I'll tell you what, I was very surprised with their 140% growth in revenues. This is what you can see, a typical buy and breakout. You see the move here, the drop at 685 was a double bottom. Here, March lows, and then May lows. And then right now, this August, it is a higher low. And with earnings actually positive, this is not the only time that Clover Health was squeezed. From 6, it rallied to 28. Is it possible that from 8, it rallies back to 28? Because I think that this is a Reddit favorite in a high short bet, this is a squeeze, guys. Similar to the GME and AMCs. If all the Reddit were to collide and wanted to buy Clover Health, I would say that this move can go at least 11 first and then 17. I only am interested with companies that have at least 20 to 100% upside. If the upside is not even going above 20%, I wouldn't even talk about it. If you're just thinking, 11 lang yan, it doesn't make that sense. Yes, 9 can go 11, but can also go 17. If you want to make money, focus on these companies. Hims and Hers, also a big breakout. Take note, this is a capitulation. This is what I'm looking for when I'm bottoming out. Huge volume, huge earnings catalyst, and a bear that's about to get squeezed. This is going to get a squeeze move. In my view, $8, a quick move to 15 is not impossible. Yes, you can argue that there are lots of sellers here at 10 and 12. Why? That is the SPAC IPO price. I would argue that there will be resistance at 10, 12, and 15. But ultimately, 8 to 15 presents to me big upside. Is it a buy tonight? Yes. Even if you missed buying last night at 10% higher, tonight, even here at current levels, all the buys that I'm giving tonight, it is a buy, market price. I'll give you another candidate. Okay, so these are the easy buys. Walt Disney, very good numbers. Who doesn't like Walt Disney? Very few. 110 million subscribers achieved, more than 110 million. And that's actually what Netflix, half of what Netflix did in a lot of years. In 10 years' time, Netflix achieved around 250 million subscribers. Walt Disney achieved in 2 years' time 110 million. Now you could argue that maybe 10 years ago, who is Netflix? And Disney is different. It has already the powerful franchises, the category killers, and so it's easy for people to subscribe to Disney Plus automatically. Either way, you should acknowledge that Disney is the first inning in a very long run season. If this is a football game, this is just the first inning for a long run NHL season. This is a streaming season war, and they're gonna have 61 countries and global movement. So the numbers of Disney are all positive. It's not just a reopening theme, but even the theme parks already had $932 million of profitability. You want to actually read the numbers and deep dive it, but the answer is tonight's gap up at 189 is reminiscent of the gap up here. Notice here, 120 rally to 150, gap up here. What was the gap up here? It was just a phase 5 MCU universe. During November, there was the November vaccines. This was a 20% gap up on Walt Disney. And then the earnings here was about revealing the phase 5 of the MCU universe. All the category from Shang-Chi, all the Marvel universe, cinematic universe, Kevin Feige, Bob Chapek, all of the Star Wars, they talked about what they will do for the next 5 to 10 years. If you didn't listen to the earnings call here, this was the most important call in my view. The November 2021, this 4Q 2020 report. That was a very important report from Walt Disney. Now, from January, from first quarter and second quarter, this was a consolidation that was very important for Walt Disney to set up the stage for all-time highs. So look at this. Walt Disney always hits all-time highs, gap up lagi. Gap up here, 10%, another 10% gap up. And tonight, I wouldn't be surprised, it's a gap up of 10%. 198, 200 possibly. And then what happens after a gap up? Usually after a gap up, it consolidates like this. For the next 6 months, it consolidates and then a gap up to 220 and then a gap up to 240. Every time it consolidates. Ganyan style si Disney. You have to learn a company style quarter after quarter. The biggest moves of Walt Disney always happens on news disclosures. Yun lang yun. If they fail, 220 goes 200. Ganun lang. Total Disney subscribers grew at 116 million, handily exceeding estimates for a total of 113 million. The result was a welcome print for investors. Disney Plus posted the weakest quarter for growth since the debut, new subscribers rising by 8.7 million. Still, the streaming platform rose notably since launching in late 2019, subscribers breaking above 100 million in just 2 years. Their broad library content being the key success to date. ESPN grew 75%. 15 million, strong lineup of live sports helping boost viewership. Who are the streaming winners? Many, not just Disney. Curiosity Stream did well. Fubo TV did well. This actually underlines the fact that Roku dropping is actually a buying opportunity because we are seeing connected TV and streaming as a whole, as a sector, is all in a bullish front. That's why Roku dropping to 350 or 360, guys, is a buying opportunity after a drop from 480. In terms of films, Marvel names including Loki, Black Widow, theatrical releases, Disney Plus, Disney returned to revenue growth for the first time in 5 quarters, more and more recovering parks business. The biggest notable growth that I saw from Disney was the return to profitability. After 5 quarters of losses, Disneyland Paris, Disneyland in California, they have opened their global theme parks and they are back to profitability. We'll go through the tables later on if you want the numbers. Let's talk about the easy all-time high moves. Unity, we like the numbers. And what they did was Unity acquired Parsec, $320 million this quarter. And look at this. Actually, I thought it was a year. It was just 6 months pala. From March, well, actually, it was around February to August. That would be about 6 months, right? Two plus 6, 8. So there was a gap down here in Unity. Why was there a gap down here from 150 all the way dropping to $80? It dropped here initially because of decline in user growth. This is what we mean with buy and hold, but buy and verify. Obviously, the people who got this Unity sold from these levels at 130, and yet because they like Unity, they bought back in at 80 all the way to 100. So far, in the last few months, 110 was a very difficult resistance. But after today's earnings calls, the recent earnings calls last 2 days, Unity broke out from 110 all the way to 130. Notice 6 months worth of effort, and then the next 6 months, or actually was happened in 3 days. You can clear a 7-month move in just 3 days. That's how powerful earnings catalysts always are. This means that Unity will always have a support at $110 or $120. The next moves are first resistance is 140. But after a break of 140, it's 170. It was proven that Unity is the only company that has been getting revenue growth from non-gaming industries. In their second quarter report, Unity was showing that they were getting growth from automotives, from architects. So they were actually getting market share from non-gaming industries. I think that is the reason why Unity went up. And the market actually liked the fact that Unity acquired Parsec, because Parsec allows all game developers all over the world to actually work on their games remotely. That is a positive thing on Unity. 48% revenue growth, I would assume that actually it's just in line. But I was expecting that, to be honest, I thought that the market was going to be muted in the reaction. I was actually surprised that the market paid 20% higher. I like the numbers, but sometimes I think that the market always have high expectations. So either way, first resistance 140, but you can already see that this is setting up that the market knows that if they believe in metaverse, it is impossible for that metaverse, any ETF or any institutional shareholder who believes in the metaverse cannot actually have non-unity. They will always have unity. And this also tells you what? If they're willing to pay a high price for unity, you have to think twice about Roblox, and you have to think twice about Tencent. And you have to think twice about all the gaming companies in general. Because Electronic Arts, Take-Two, and Activision didn't rise after numbers, even if all their numbers were a secular growth and just a punctuation mark that growth in gaming continues ever present. If you have a gaming stock in your sector picks, you should keep them. And if you're selling it, it's fine, but you have to always buy it at 120 or 110 because these are going to be going up in the next few years. These are the metrics on Unity. Growth of about net retention rate. So yan. Nakita ko revenue was 48%. Hindi siya nakasulat dito eh. But all of them was actually a beat. Okay, let's take a look Palantir. Every number is a beat. So you could see what happened here. When a company is expensive, the only thing that happens is it consolidates. So this went from 10 all the way to 40. That was an overhyped move. Naturally, it dropped to $20, even expanding growth, even going down extremely to $17. But over the last 8 months or 10 months, all that Palantir did was wait for earnings. And when earnings came around, it broke out, finally. The first resistance of this breakout is 27, and then 30. You would assume 27 is the first resistance because Palantir is often questioned about the valuation. So I'm not sure if it will go to 35, but I do know 27 first resistance, but 24 below always has a buyer. The bulls have been validated for their conviction. Revenue up 49%, $376 million. Commercial revenue 90% year-on-year. Closed 62 deals. 62 deals of $1 million. 21 deals, $10 million. 20 net new customers added in the second quarter. Full year, they're raising outlook, adjusted free cash flow in excess of $300 million. With these types of growth rates, it tells you that people are willing to pay high for an execution as this. So whenever you forget next year, let's say Palantir has drops, these results will just let you know that, okay, every time Palantir drops 24 below, I'm a buyer. Okay, Origin, very strong growth, 17% happening after hours. Since announcing business combination, they've tripled their commitments from customers, 300%. From $1 billion to $3.5 billion commitment. Milestones for Origin 1 and 2 are still reaffirmed, and they still have the ability to fully fund the construction. So people are actually willing to wait a year before those facilities are open. So construction risk, right? We do not anticipate any requirement for financing our business plans. We continue to expect construction by end of 2022 and Origin 2 to be end of 2025. Every now and then you will forget these things, so remember the reasons why you're investing, because you have to be always bullish whenever Origin drops. Highlights. They got clients. So committed, Ford, industrialized new materials to drive decarbonization in the automotive. These are their new clients secured for the quarter. So Ford, Mitsubishi, Solvay. So these are all automotives. Primal Loft for outdoor gear, bedding, apparel. Iconic brands include Patagonia, Stone Island, LL Bean, Lululemon, Adidas, and Nike. So they have clients for the rubber shoes, right? So Lululemon. As big as the sales are, all of these want to be carbon negative. Partnership with packaging materials to build an existing 10-year supply agreement. Partnership with asphalt to develop low-carbon asphalt. Imagine, low-carbon asphalt means cement for your housing to be biodegradable. Amazing stuff. So that would be beneficial for all residential builders. And that's something that Biden wants, sustainable economy. AECI Sands, technical fiber to develop carbon negative materials for apparel and automotive applications. And then, of course, with Palantir, they have a strategy to focus on decarbonizing the global material supply chain. Net income. I don't think people actually expected them to actually have income. So from loss of 1.7 to income of $62.5 million. Based on current business conditions, the company expects to also be within their previously provided guidance. By the way, $3.5 billion was not expected by the market. So that's why Origin Materials is trading at 750. Okay. The chart of 750, I don't have the chart by here. Okay. Showed you the chart. So obviously we think a V-shaped reversal is happening to Origin. So 15 to 5. It is not unusual for Origin to actually go to 10 and then eventually to rally back to 15. So this is Origin Materials. Why did I start with companies that fell 80% down? Because this is a company that fell 80% down. 14 fell to 5, almost 80% down. 5 going to 8, 9, 10, eventually after a consolidation back to 14. So think about the bullish case, not just the bearish case, because the bearish case is gone. The bearish case is that, okay, it probably drops 6 or 7. That's about it. So buy the dips because these are 100% to 200% movers, something that even a Square cannot give you. Because a crowded favorite like a Disney or a Palantir or a Unity will not give you these things because these are change in sentiment types of companies. So of course, these are going to give you a bigger upside. For low risk. Okay, let's take a look at this movement. Okay, these are the results of SoFi. So SoFi is such a match pack that didn't actually beat the earnings. But take a look at the members. From 700,000 members to 2.5 million members. And then these are your products in thousands. So $3.6 billion worth of products. Products by segment, growth is there. Technology platform accounts growth. So SoFi, I think, is dropping 9% after hours, but I think you can do a contrarian move here. Let's take a look at this. Fintech in general has all been doing well. Square, PayPal, SoFi. Okay, SoFi, we're going to go contrarian buy here. Upstart, super strong growth. Lending Club, super strong growth. So almost all the microfinancing fintech companies have done very well. As a sector, we like it. Let's read the numbers. Revenues of SoFi, $230 million, up 100% from the year-on-year period. Second quarter, 237 million, record high, 74% higher. SoFi's business segments grew in these measures. They recorded a $163 million loss, and this is the reason why Wall Street is selling it down 9% after hours, which we will buy, because it is a loss from Galileo. Galileo is a buyout from us. We acquired a company. This decreased our valuation allowance by $100 million, and we have significant non-cash stock-based compensation expenses, which led to the largest contributor to our net loss this period. Second quarter adjusted EBITDA was $11 million positive for the fourth consecutive quarter, $35 million higher than the second quarter of 2020, offset by increased spending to achieve incremental growth. Company is accelerating year-over-year products and numbers and members. Members grew to 2.6 million, up from 1.2 million. This is what you want in a business. Growth in your customers, and the products also grew from 1.6 to 3.7. Growth was driven by all across the segments, particularly in the financial services segment, where growth in SoFi Invest and SoFi Money offerings tripled the number of financial service segment products to nearly 2.7 million. Do you know a company that is growing 200 to 300%? I'll give you one example. Futu and Tiger are registering that. And we're also contrarian buyers on Futu. $100 can go $60, doesn't matter. Business growth is improving. 200, 300%. That's why if you buy 100, if it goes 90 or 70 or 60 for Futu, you will not hear me say it's a sell. It's still a buy, it's still a buy. SoFi 16 you bought, 15 you buy. Whether it goes 14, 13, with these kinds of numbers, we will not change our view. We are very consistent. Awesome 10X style is very simple. If the business is improving, I don't care if your cost is 20 or 25 or 10. At the end of the day, these numbers merit a buy. That's all. So we think that the growth in the fintech sector is proven by almost all of them. And so this is a buy. Technology platform accounts increased by 120%, nearly 79 million, due to the client acquisition by Galileo and growth at its existing clients. Okay, let's talk about another fintech that's hitting all-time highs. Upstart, yes, this is a company that went 7x, about $20. Okay, it's going 8x already, 9x, $20 to $180. So prior to the earnings calls, it was about 140. Because of super beautiful numbers, it rallied 20%, and we do expect that any dips of Upstart will be bought. In fact, SoFi has to thank Upstart, because if the market will revalue and pay lending companies this high, this is an AI lending platform, it means that SoFi, which is also in the same business, can actually be valued at the same price. Our Upstart revenues grew to $194 million. So a while ago, you saw SoFi has $240 million. It's actually higher than Upstart. But the reason why Upstart went 7x is because it came from a low base. Upstart didn't have $10 billion valuation to begin with. Okay? Upstart had started with less than $1 billion before. And because it had less than $17 million of revenues a year ago. Upstart revenues up 60% compared to the prior quarter. June is our first month with more than 100,000 loans, more than $1 billion in origination volume on our platform. Ask yourself, 100,000 loans here. If SoFi can do 100,000 loans, they can actually do what Upstart's doing. And so can Square do it, and so can PayPal do it. So the move of Upstart comes from super micro cap in the fintech space versus the big behemoths. Okay? So that's the reason for that tremendous growth. Small cap or micro cap versus a big cap. We achieved this growth delivering record profits, adjusted EBITDA. I'd say that the growth here came from a secular tailwind. Without the COVID pandemic and people actually needing a lot of money to be borrowed, they all turned, millennials and Gen Zs all turned to companies like Upstart, Lending Club. All of that is happening to get special growth. Something that we also saw when e-commerce results in the last year happened. Everything was blockbuster. Shopify, Mercado Libre, e-commerce limited, everyone in the e-commerce space. Same for Alibaba and Amazon. I think it's what's happening here in the lending space. We are happy to report 97% of our revenue came in the form of fees from banks or loan servicing with zero credit exposure or demands on our balance sheet. So Upstart is actually helping banks give those loans for the people. In the second quarter, we drive separation between our AI-powered platform and more conventional lending systems. We eliminated a rules-based constraint in our model, handling situations related to the size of the loan requested. With more powerful algorithms and growth and training data, our models are now handling that issue natively and with more precision. This led to a boost in approval rates and a more accurate system overall. Let's read through some fintech names that are gonna go all-time high. So in general, we like fintech. Square, PayPal, Upstart, SoFi, all of them, we expect them to hit all-time highs. Year-over-year revenue growth of Square driven by strong momentum across Cash App, contributing $3.33 billion to net revenues in the reported quarter, up 177% year-over-year. Solid momentum across Bitcoin was the key catalyst, but even without Bitcoin revenues, net revenues would still amount to $2 billion, up 87% year-over-year. Strong growth in transaction, subscription, and hardware revenues contributing well to the results. If you ever wonder why Square is being priced 33 times price to sales, look no further. These kinds of growth and domination is what you pay for a great execution. Square witnessed solid traction across the seller ecosystem, generating $1.31 billion of revenues, up 81% year-over-year, accelerating gross payment volumes driving the results. You'd see the same numbers happening in all across the board. So these are the numbers. Cash App generating these profits, up 94%, generating gross profit of 1.14 billion, up 90. Seller ecosystem, gross profit of 585 million, up 85% year over year. We're talking about these companies as bigger or potentially higher growth than the FAMGA. So if you think about it, should you still buy the Facebooks, Amazons, Microsofts? You have these big caps like Square, who are actually delivering super good growth, and you have an ability to grow 3 times better, and it actually has a business model that is very tough to beat. In essence, they're actually monopolies of their region already. Square and PayPal are already the fintech global payment leaders today of US. As customers find value across the ecosystem, they've got adopted more products, bringing a greater amount of funds into Cash App. Compared to 2 years ago, inflows per monthly transacting active customer nearly doubled. Gross profit customer was up 2.5x. Software and payments have been the fastest growing products in the seller ecosystem, delivering an average annual gross profit growth of nearly 50% over the past 4 years and have improved seller retention. By the way, Square also bought through stock deal Afterpay for their buy now, pay later. When you see a business growing like this, all Awesome 10X wants to do is buy more and more. Average up. So if we know how to average down, we also know how to average up. At the end of the day, averaging down and averaging up has no care about your price. It doesn't matter if your cost in Square was $50. Even at $250, $270, you'd have to average up. At the same time, Origin, doesn't matter if your cost was 10. At $6 or $7, you have to buy a business like that. That's what I mean. When you're focused on the fundamental consistency, the prices don't matter. The question is where it is going. Is it going to go up 100%? Is it going to go 500% up? Because I don't care if it fell 90% down before. Neither do I care if it went up 500% in the past 5 years. Because if it's going to grow higher, the answer is a buy. So that's what you're seeing here. All-time highs for these will continue. These are the kinds of numbers that Square is posting. We don't think $280 is expensive. Any dips to 60 to 70 to 40, who cares? August, Fed, whatever, meetings, macro events, doesn't matter. The point is keep on buying Square. These types of profits are what we love in a business. Okay, so I'm gonna give you a few slides here. Actually, I tried to make a table. I'm not sure if you can see this clearly. Should I actually zoom in? Okay, so I haven't finished my table, but I'll tell you what. So these are some of the companies that I've had in my list and I've been studying. For Pinterest, negative 20% gap down. It's still a trend following name. Earnings is a miss, but revenue is a beat. Pinterest managed to grow their revenues 125% to $613 million. They didn't raise their guidance because what they've noticed in their quarter is that people are spending less time at home and going out. And because they believe that it's going to be detrimental to their digital advertising if more people go reopen, it got a suffering of negative 20%. What Pinterest earnings results only tell us is that it is admitting that buying reopening stocks is where the money should flow into. So sometimes you don't need to buy Pinterest, or you just have to understand there is a support at $50, but a strong resistance at 66. Okay, so that's what I could say. No guidance, lack of visibility. There is no conviction to buy Pinterest. Clover Health is a 10% gap up. Last price $9, reversal move. This is a company with $6.50 low, $29 high. While I expect it to go up, I don't know if it's going to be going from 9 to 27. Nonetheless, I know that the move is upside. Beating in revenues, beating in earnings. You might argue that how could it be beating in earnings? Raise guidance. Yes, this is a negative 317 million loss. Yes, it's a $412 million win. But the fact is they've got members signing up. So there is a massive scale in growth, and they've got $1.5 billion of revenue. And in my view, Clover Health is going to be short squeeze candidate. Same thing for Open Door. Open Door, you'll wonder, $1.2 billion of revenue here. This is a reversal and yet a loss of $144 million. My guess, with the raised guidance and growth of revenues, Square, PayPal, when they were starting, they weren't actually expected to earn money. So these companies are just trading on revenues. So revenue growth is the more important quality when you're buying companies that are disruptors. Clover Health is going to try to disrupt healthcare industry in the senior stage, mga senior na yan, age. Open Door is for millennials, Gen Z, well, boomers, everyone technically. So everyone in the real estate. Raise guidance. The trading pattern here is very simple. Buy and breakout for Open Door. Buy and breakout for Clover Health. Initial TP, okay, $12 TP for Clover Health, $22 first target price. You'll notice the first target price is just 20% higher. But the actual move of a reversal in a 1 year time, at least 100 to 200%. If every quarter is a beat, and then the next quarter is a beat and a beat and a beat. So this is just the first quarter of a beat. Take note, you can have 7 to 10 quarters of beat and beat and beat. And if you were looking at that point, that happened when Square was happening in 2015. 2015 till 2021, Square went from something like $20 to $280 right now. It's very important for you to follow your buy and hold every quarter, because if it's a beat and a beat and a beat and raise, it's always buy and buy every quarter. That's true for what happened. Your C Limiteds, your Pinterest actually has beat and raise. Sometimes it, like right now, it's not a beat, but it's actually gonna consolidate. We're not bearish on Pinterest. That's why it's a trading range. SoFi, in my view, is a trading range, but in my view, it is a willing contrarian for me. Full year guidance was lowered by just 5%. They don't want to raise their guidance. And negative 165 million loss here, 259 million growth in revenues. I like the fintech sectors. I'm willing to actually buy 15. Yes, 20%, sell 18. But if they manage to make a beat yet again next quarter, this is going to go higher. So just be aware of earnings as 3 months, keep on buying and verifying every 3 months. Upstart, we know it's going to be trend follow to all-time highs. So any dips will be bought by momentum and by investors. Square and PayPal, in my view, trend follow to all-time highs. I'm gonna give you Datadog and team, trend follow to all-time highs. Disney is a trend follow to all-time highs. Origin is a reversal move. I love reversal moves. Palantir is a trend follow move. You could see that the trend for Palantir has always been bullish. Everyone likes Palantir and Unity. NVT, in my view, okay, NVT is we are contrarians, just like SoFi here. NVT beat on their numbers more than 100% revenue growth, and yet you can buy NVT today at about 26. The first resistance on NVT is about $32. But eventually when that 32 breaks, next quarter, a beat, boom, another 20 to 30%. The way to make money, awesome 10x style, is to follow the earnings every quarter, because if every quarter is a beat, it will just continue going up 100%. That's what happened, of course, with the likes of, let me show to you companies that have continuous beats. Okay, so this is something that you already probably know. CrowdStrike, right? Earnings beat, earnings here. Even if it beats, it actually drops. Sometimes even if you beat, because the earnings are already high, it will just consolidate. And then this was also another earnings beat. And then we do expect an earnings beat on CrowdStrike. So this is what happens when you keep on getting 10 quarters of continuous beats from about $50 all the way to $250 or 5x. So Shopify, just for you to know, even if the market is not buying it up, we do expect it to go all-time highs. Because for the last more than 3 years or five years of quarters, it was always a beat, guys. So beat lang yan. So it always is a buy every quarter. So these are what Awesome 10x does. If it's a beat, wala, buy lang, buy and then never sell hanggang all-time highs. So that means if Origin will beat next month, yet again, next quarter report would be on December 1. If that's a beat, malamang $12 na yung Origin by then. So November pa lang, naka 100% move ka na sa Origin. Hindi ka na maghihintay ng, don't listen to people who say, oh, you're gonna wait a year for 100%. Hindi. Kasi when you have an undervaluation aspect here and a reversal play here, 100% in 3 months is possible. That's what happens with a beat. This is what's gonna happen with Clover Health and Hims and Hers, okay? So these four, in my view, we have the 4 men to actually make 100% in our view. In earnings call, kapag before December nito, ano pa lang ngayon? August pa lang, di ba? 3 months. Test us with our view. Open Door, Hims, Origin, Clover Health, these 4, in my view, is a short squeeze candidate. Now, we don't see a bullish move pa on Doyu. So you have to wait for the business update. Ashford, I'm beginning to assume magkakaroon ng day na 100% up yan. So let's try to understand why it even went up 300% up before. Ay, shock, 7 p.m. na pala. Sorry. I didn't notice the time. I thought it was just 6 p.m. But this is your assignment, everyone watching. Try to find out this day, November, from about $14, this rallied to $60, $50, 300% up in a single day. I asked the people to tell me if this $14 is not going to go $50 one day. I don't know when that day is, but it will, in my view. So that's it. Thank you for watching the Awesome 10X and have a good day. Sorry I didn't answer all your questions.